time to get back to work. Now we shall talk about the financial derivatives, which can help you to do risk management immensely. Please remember that financial derivatives like insurance contract, like you buy insurance, okay? The derivative contract that we use, there's several, but I would only use the principle, the main derivative contracts, which were, they have been in this world for many years, many decades, or even century. All right. Nowadays we have some variations of the original contracts, the original instruments, but I would stick with those old instruments. We shall have four type of medicines, four type of derivative contracts: the forwards, the futures, the options, and the swaps. These are the four contracts, the four derivatives which we shall use to do the financial health treatment of the company who have some challenges. And I'm sure there's no company, not a single presentation was showing that, hey, there's no problem. There are rivers of milk and honey in the company. The company has no problems at all. There will never be any problem. You all came up with the challenges. Even the most successful company, which some of you took up, they also have some issues and challenges. Okay. The first contract which we use is the forward contract. Okay. The forward contract is the most rigid and old-fashioned, very old-fashioned medicine, I would say. Okay. What we do here, the forward contract is an agreement between a company, which normally is a big multinational company, exactly the company you guys chose, and the bank. And the bank is not a small bank. The bank is of the reputation of HSBC or Royal Bank of Scotland or Barclay or Royal Bank of Canada, these kind of banks, who are really big names in the financial world. But if you are in a small country dealing with a small bank, then your bank can have a contract with a multinational bank. So the forward contracts could be directly between a customer company and the bank, or it could be between a local bank on your behalf, because you can be an SME, and the big bank. So normally the forward, but I shall explain in this case that when a company directly can approach a bank for the forward contract. One thing we should know about the forward contract is very important. Well, everything is very important, but I write this thing: specified. You think it's out of fun? Well, partially, yes, but not fully. Imagine, now you are the same company who was buying inputs from Canada, all right? But this time you are a little bit, this time you don't want to see you don't want to feel the, the brunt of the market fluctuation. This time you want to hedge, cover your risk in the very beginning. All right. And what was the equation, by the way? You were buying 10,000 tons of money, of inputs at some price. I think it was 300 Canadian dollar, which makes 3 million. Yeah. And the price was, in the beginning, it was 70 European cent. All right. Now what happened? Now the story changes. This time you are in a boardroom in your executive board, and the CFO is leading the meeting. And the CFO is saying, hey, folks, we need to buy 1,000 tons or 10,000, whatever, inputs from Canada. And the price now is 70 cents. But there's a danger that when we execute the order next year, the dollar can jump from 70 to 90 cents, as it happened when you were uninsured. There's a chance the global trend shows that euro is struggling, but the Canadian economy is doing wonderful. So it's quite likely that the Canadian dollar will become stronger than euro. And if it happens, then we may have to pay 2.7 million euros instead of 2.1 million. Can we do something so that this situation doesn't arise in the first place? And the board says, yes, let's call our banker. And you call your banker, or you approach. And you say that, Mr. Banker or Miss Banker, we need Canadian dollars so that we can pay our supplier. And the Canadian dollars were how many? How much? Let me have a look. It was, I think, sorry, I want to be precise. So we need to buy 3 million Canadian dollar. So the first specified word you talk to your bank manager is that we need 3 million Canadian dollars. So the specified currency. The specified currency is Canadian dollar. All right. So if you have this contract in Canadian dollar, you can't convert it to Mexican peso afterward. It has to be. So you have to keep this contract in the same currency in which you take it originally. No looking back. It's a very irreversible process. Specified amount, 3 million. Specified currency, specified amount, specified time. Let's say you will be paying your Canadian supplier in 3 months' time. Yeah. And today is what date? 27th of March. So it means you buy the contract today for 3 months. April, May, June. This contract is valid not for the whole life, but for till 27th of June. And then comes the most important thing. You are asking, okay, what rate you will sell us? You mean the company is asking the banker that at what price in euros I would be buying Canadian dollars. And you know that today's market price is 70 cents. Here, this is a little bit gray area. Lots of bargaining also happens. If you are an indispensable customer for a bank, then they will bend down, all right? And if you are not a very big customer, but the bank is indispensable for you, you have no option, then the banks can dictate terms. All right, so here you negotiate. All right, when you negotiate something, can I say that there's a table between you and the bank or a counter? This contract, which is negotiable, is called over-the-counter contract. Have you heard this phrase, OTC? Over the counter. Over the counter is a process whereby the buyer and seller are sitting across the counter and they negotiate. And the one who wins the bid, who has more bargaining strength. It's not like that you go to the market. You know, when you go to the market, you have to take the price as it is given. I always compare the OTC contract that if I want to buy a jacket, which I have actually, it's quite fine. If I go to a store and I don't find any jacket of my size, so over there, I have to take those. I can't ask a sales assistant, can you stitch a jacket for me? They say, hey, it's the market. They are hanging, the coats are there. Go, suits you, take or leave. The second option is that I can go to the tailor and I ask the tailor, Mr. Tailor, can you make a tailor-made suit for me? So the OTC contracts are tailor-made, customized for you. And how they customize, it depends upon the negotiation. And let's say, whatever the process is, the deal is that you will be paying 73 cents for $1 Canadian. And then when these 4 specifications are done, then both parties sign twice. One paper is with the bank and the second is with you. The forward contract is signed. Okay? See the beauty. See the beauty. Today, on 27th of March 2019, you know for sure that on 27th of June, you will be paying this multiplied by this 219. You know for sure that your import bill is 2.19 million euros. If you don't sign this contract, then every time you'll be looking at Bloomberg or Reuters, has euro gone down? Has Canadian dollar gone up? And if you are a company who signs several contracts, you are not only, it's not only one contract, you're a multinational. You may be having such contracts, dozens and dozens in a day, with dozens of currencies. Can you keep yourself unprotected, unhedged? No, you must not. You must be proactive. So it's like a financial insurance. Now you know for sure that come what may, whatever happens between today and 27 June, I am not going to be affected by it because I know for sure that I will not pay a single penny more than, a single cent more than 2.1 million euros. This is a forward contract. And what are the characteristics? There has to be a specified currency, specified amount, specified time, specified rate of exchange, and none of them is changeable. That's the thing. Whatever you decide, you can't change. If today you sign this contract in Canadian dollars, all right, and you can't go to the bank next day and say, could you change this currency from Canadian dollars to Swiss franc? No, you can't. Then you have to sign a new contract. What about the old contract? Can you cancel it? No. You cannot cancel your old contracts. This is a very old-fashioned, rigid contract. No looking back. We use a phrase in forwards, lock in. When you and bank sign, we lock in. Lock in means now this contract has become irrevocable. No party can cancel this contract. The worst can happen is that you sign the contract today and tomorrow on 28th of March, you decide that we will not buy anything from this Canadian company, right? And then you go to the bank and say, Mr. Banker, you know what? Until yesterday, we were going to buy something from Canada. We have canceled our contract. So please cancel our forward contract. They say, no, are you joking? You have to honor it. That's your problem, not my problem. Right? So it means that you have no longer any transaction with the Canadian company. But on 27th of June, you have to pay 2.19 million euros and get 3 million Canadian dollar, even though you don't need it. Okay, don't need it, go and sell in the market then. Do whatever you want. But the bank will not cancel the contract, nor it will let you cancel. If some companies try to cancel it, there can be serious legal repercussions to the extent of blacklisting the company. So, as I said, lock in. This contract is locked in. Once you sign, no power on this earth can cancel it, except that the markets can collapse or whatever happens. That's a different situation. But in the normal course of life, this contract is irrevocable. This is very important to understand. And these 4 specifications: specified currency, you can't change it. Specified amount, you can't add or minus even €1 to it. Specified time, no. If you have to take this payment on 27th June, it cannot be 28th June. Specified amount, you agree the rate of exchange, stick with this. Yes, one thing you can do, that before you sign the contract, you can put your weight in the negotiations. All right, so you can put your weight if you have any weight. But once you sign the contract, nothing could be changeable. This is the forward contract. But the good thing is that, even though it sounds very rigid and old-fashioned, the good thing is that now you know for sure. You don't have to have those nightmares that what if Canadian dollar appreciates? You know, if it appreciates, it could be a problem. You know the last example? It went from 70 cent to 90 cent. And it literally killed your finance. All right, now you don't have to worry about this issue. You know for sure that your cash outflow will not increase by an iota more than 2.19 million. Well, it's a risk. It's like buying the car insurance and not having an accident, right? I mean, you see the situation. It's like insurance. We buy car insurance, right? If we have an accident, God forbids, we get the compensation, yeah? But if we don't have it, do we decide? Imagine, it's not legally required to have car insurance, yeah? And you think that, hey, I think I drive very carefully. The last 5 years, nothing has happened, all right? So why do I pay car insurance? But see the situation, if it happens, something happens. Scary, yeah? So this is like an insurance premium cost you pay. You're right, you have a very valid point that what if it depreciates? Well, we always protect ourselves against downside risk. Yeah. But you have a valid point. In the next contract, which we shall discuss, we can try to make this contract softer. But for this contract, no change. We can only repent. But that repentance would be less repentance than the movement goes against you. You get my point? Yeah. So it's like the bitter pill we take. Yeah. Am I recording it? Yes, I am. Good boy. Yes, example. A Finnish firm is purchasing products from US MNC subsidiary based in China in US dollars and selling them in Finland in euros. It's usually making, so it's like a 25 million USD and paying in 45 days. What should you do? Well, what are you afraid of, first of all? Because you're importing. So when you are an importer, you're always afraid of the foreign currency appreciating. So it means that you are afraid, you are exposed to the risk of USD appreciating. And what you can do, well, you can buy a forward contract. You buy a forward contract to finance your import bill, simple. The same Finnish company, as in the previous example, this time will sell to Mexico, but it will sell in American dollars, right? But the problem is that this company who buys from you in Mexico would pay you after 45 days. What are you afraid of? First of all, what are you exposed to? Well, then you are exposed to the USD getting depreciated. Let me draw a matrix. Isn't it red pen? Foreign exchange appreciate, depreciate. When you are an importer, if foreign exchange, if you are an importer and you are buying the foreign exchange, if it appreciates, it's risky, red, yeah? And if you're an importer and the foreign exchange depreciates, it's good for you. But if you are an exporter, and the foreign exchange which you will get appreciates, good for you. And if you are exporter and the foreign exchange which you will get depreciates, is bad for you. So you can remember this table, and this will address, like a matrix, can help you to understand. Yeah, one thing, usually these forward contracts are very high value contracts, right? So the minimum amount could be 1 million or more, right? So if you go to holidays and you want to buy forwards, it's not a wise idea unless you're super rich, all right? So this is basically for the business purposes. The forward contract markets are very big, very big. I will show you at some stage at the end of this topic that the foreign exchange market daily transactions are around 12 to 15 trillion dollars a day, right? And normally there are 250 working days in the market. So if you multiply 15 trillion by 250, I don't see, is there any way to measure it? Is it gazillions or whatever you call it? Whatever. Okay, but so the market is super big. The forward contracts are never traded in the secondary market. Can somebody tell me what exactly is called secondary market? I explained slightly a little bit more about the primary and the secondary market. The primary market is that, let's say Nokia issues shares, right? Nokia has an IPO, the initial public offer. I buy a share straight away from Nokia. And then I sell that share in Helsinki Stock Exchange. Now I buy in the primary market and sell in the secondary market. All right. Alternatively, I can buy from stock exchange today for 10 and sell tomorrow for 15. So I buy from secondary, sell in secondary, right? There's no secondary market in the forward contract. Why? Because it's very highly customized, tailor-made for you. Remember the situation? You are negotiating with a banker across the counter, over the counter. So if something is created only for you, it's not likely that it would be suitable for you, even though I bring somebody else. Hey, from now onwards, she is responsible for the contract. Bank says, no way, no way. Remember we signed? No change. Lock in, no change. You and only you have to honor the contract on 27th of June, 2019. Nobody else can come in your place. So there is no secondary market, right? So it's not like a stock market. Settlement by actual delivery. You have to, on 27th of June, you must pay your bank, Nordea, for example, 2.1 million euros, 2.19 million euros in order to get 3 million Canadian dollars. So there has to be a delivery. All right, let's see this example. Consider a company that requires New Zealand dollar 2 million in 90 days to purchase imports from New Zealand. Assume that the spot rate means now, today, the market rate is a New Zealand dollar 80 American cents. So let's say Yeah. So if you have to buy this contract today, you need to pay 1.6 million American dollar, but you don't need it for 90 days. The one possibility is that you can go, even though you need to pay them in 90 days, who? New Zealand company. You buy them today. But then the question is that, how can you do this thing? How can you buy dozens of currencies whose payment is needed after 6 months, 9 months, 1 year, 2 years? Should you buy them right now and keep in your in the basement of your office? No, it's not possible. And it involves lots of cost. Remember, you pay interest. So don't think that it's cheap. You can't just buy it today unless you need it. Yeah. So what should you do? You go to the bank, and let's say the deal is that you can buy 1 New Zealand dollar for 82 American cents, which you will not pay today. You will not make the payment today, but often on 90th day, right? It means that now, today, you are sure that in 90 days time, you need to pay 1.64 million American dollars. So that locks in you, all right? These contracts are tailor-made. As I said before, normally they are for 30 days, 60 days, 90 days, but they can be for a very long time. I have seen some companies, when the students were making presentation, that they buy forward contracts for even 20 years. Mm-hmm. Especially the companies who are spending money in infrastructure and R&D, right? So you can even have the forward contracts for 20 plus years. And if you are a state and you are borrowing from, you have to pay International Financial Corporation or the Asian Development Bank or World Bank, then this forward contract could be even for 50 plus years. Okay, but even for the private companies in the normal corporate sector, the forward contract could be as long as 20 years and even more, because everything is possible. Before you sign the contract, everything is flexible. But once you sign the contract, no change. Okay, yes.
That long period of time, what are the rates in practice? Like, is it like 10%?
Banks normally have a team of econometricians, researchers, and they can do the forecasting. So if you go to Nordea branch in Keskusta and you ask that you are interested in buying forward 20 years from now, probably they would not give you any answer, but then they will call their research people in Helsinki, in Vantaa, and they would find out that what is the forecasted rate 20 years time, and then they will quote you a rate which you negotiate with the bank to sign the contract. And if they don't have the information, all right, then they will call the bankers association. For example, there is a bankers association of UK or America or elsewhere, and they will ask them that, hey, what if you have to deliver Canadian dollars in 20 years time, how much rate will you charge? So you can ask the further research experts. Yes.
Comparison has to be more than for
Not,
60 days.
no, not necessarily. If the trend is downwards.
For 20 years.
Yeah, it's possible that some currencies, the trend is downwards. Why not?
But it doesn't like move that much in the 20 years or what?
Of course, you have to keep into account not just the exchange rate per se, but also the inflation rate and the interest rate and some other market premium. So there are 4 or 5 determinants. When you mix them together, then you make a forecasted rate. As I said, you have to be a trained econometrician. Those people who work these kind of things, they are normally PhD in maths, finance, and physics. These 3 PhDs are very famous for these banks' forecasting department, maths, physics, and finance. Okay. Yes? Now I behave. All right. I think William, this relates to William's point that is it always that the forward price be more than the spot price? Well, it depends. It depends. Imagine on 27th of June 2019, $1 in the spot market. Spot market is a right now market. Exactly. If you go to, in Keskusta, some currency shop, and you want to buy $1, and they say euro 75. All right. And then you go to a few steps away, you go to Nordea Bank, and you say, I want 90-day forward Canadian dollars. And they say that if you buy in the spot market right now, it's 75, but we have an expectation that Canadian dollar would appreciate slightly in the next 90 days. So the forward rate which we can offer you is 79. And you think that this is fair rate. All right. But the point I'm trying to make is that if the forward rate is more than the spot rate, then this thing would be positive, yeah? Forward rate minus spot rate, okay? So in other words, 0.79 minus 0.75 divided by 0.75, okay? But this is for 90 days, yeah? So if I calculate this, can somebody calculate for me how much it is in percentage? 0.74 by 75, 1800. I would say approximately 5.96%. Right? So it means that there's a premium. 5.3. 5.3, okay. So there is a forward rate premium. How much? 5.3. For how many days? 90 days, yeah? If you want to find what is the annual forecast, if it is for 90 days, multiply by 4, because there are 4 times 90 days in a year. In other words, so you can say that all else being equal, it is forecasted that Canadian dollar would appreciate against euro 21.2% for full year, for the whole year. So this is a very basic preliminary technique of forecasting. But the point I'm trying to make is that if the forward rate is higher than the spot rate, then the resultant number would be positive. And if it is positive, it's a premium. But it could be possible that today a currency is at the peak, very overvalued, but in 90 days time, it will not be. Then the bank says, hey, today is very lot of exuberance, irrational exuberance. Do you remember, Anna? Okay. And then you find that the 90-day price would be lesser, okay? So in that case, then this figure could reverse, and then it could be negative. And if it is negative, what's the opposite of premium? Discount. Yeah, so there's a discount here. So there's come on. I just wanted to check. So you're awake, okay? So in that case, there's a discount. So the premium is, the forward rate could be offered to you at a premium or a discount for a given time. Of course, you can annualize it. There's one example here. The spot rate is 1.681. The forward rate is cheaper. So it means that the economist forecast the pound to go down in 90 days time. And you find out that when you convert 90 days to 360 days, you find out that it's minus 0.95%, which means that the discount rate forecasted for the full year on pound against American dollar is 0.95%. So in other words, it's likely that in the next full year, pound would depreciate against dollar by 0.95%. Appreciation premium means appreciation, and discount means depreciation. Make sense? One thing I want to ask, it's a sidetrack information. I use the phrase appreciation and depreciation, yeah? Appreciation and depreciation. What if I use the phrase revaluation and devaluation? Have you heard them? Do you know, Anna? You know so many things. Would you like to explain? Something like that, but the process is slightly different. When the currency go up and down because of the market forces, market mechanism, yeah, it's either appreciation or depreciation. But if the state announces that, hey, I don't care about the market, from tomorrow onwards, this would be the price of $1 Canadian. We don't care about the market. When the state declares, all right, then it could be revaluation or devaluation. If the price is higher, then it's revaluation. If it is lower, then it's devaluation. But the point I'm trying to make out is that appreciation and depreciation can happen hundreds of times in a day in the market. But revaluation and devaluation is done at the behest of the state. And this rarely happens. So when it happens, it must be a real economic emergency, right? But state can also declare that we don't care about the market. From tomorrow onwards or now onwards, this would be the price of pound. We don't care about the market. I can actually show you. Maybe I showed you already. I don't know, but it's not a bad idea to see it again. Let's go to our old friend, Yahoo Finance. If you go to finance, and if I compare, the currencies, euro, US dollar. So you can see that the number of USD for a euro, yeah, and you can see that from 12 a.m. to 6 a.m. because it's a trading, it's a time difference. So you can see that the price of price of 1 euro went down. So this shows depreciation, yeah. But then after 6 a.m. the price went up. It shows appreciation, right? So you can see the appreciation and depreciation. You can count how many points are here. There are thousands of points you can calculate here. So the moral of the story is that appreciation and depreciation can happen after a few seconds. And you can see here, if you focus on this point, you will see that it's changing every time, after a few seconds, right? This is appreciation and depreciation. But the revaluation and the devaluation means the state declaration would rarely happen. I can give you one example of devaluation. The last devaluation which India did was 1991. And only because it was a rare economic crisis.
That's not long ago.
Yeah, well, it's still 28 years. And since then, there's no devaluation. It's a sign of economic emergency, right? But if you see the value going up and down in the market, it can happen countless times a day. Okay, so I have some questions for you. For the rest of the time, I want to ask you. Let's go one by one. Have a look at question number 1, and please tell me on a piece of paper, some scribbling, how you think forward can come in the picture. So questions highlighting foreign exchange exposures and risk management with the well, I should say currency forwards, not futures. All right. Sorry. Ignore this word futures. Well, it's not even futures. It's a futures. So ignore it, please. Yeah. So I can call it forwards. Yeah. So please, all of you, in pairs, in groups, or single, do number 1 question. Mm-hmm.